Corporate finance practice problem using Excel. Stock dividend and impact on investor holdings. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. Going to populate that into the blue area on the right-hand side, focusing in on a stock dividend. As we do so, we will be concentrating on the equity section of, we can imagine, a balance sheet. Equity section of the balance sheet being assets, liabilities, and equity, which you can also reformat as with the accounting equation, assets minus liabilities equaling equity, meaning equity representing the book value of the company or owners, stockholders in this case, as a corporation's claim to the assets of the company. So here's going to be our information on the equity section. We got the common stock at the shares of 6,000 shares, par value $10. Common stock then 6,000 times 10 or 60,000. Capital in excess of par 35,000. Retained earnings 55,000. Total of the 60, 35, and 55, 150,000 total equity. Stock dividend's going to be at the 12%. Market price $16. Earnings, bottom line of the income statement, in other words, 24,000. Price earnings ratio at 4. And then we're going to imagine once done with this, we have an investor with 100 shares before and after this stock dividend. Where will that investor stand before and after our stock dividend at the 12%? So what we'll do is we'll first recalculate our common stock section, bottom part of the balance sheet, and we'll do it with the same numbers just to get a feel for what it looks like, and then we'll do the changes on the right-hand side and adjust it to where it will be after we have calculated the changes for the stock dividend. Remember that the stock dividend will not be impacting the other components of the balance sheet, unlike a cash dividend, where cash asset decreases, stock dividend only impacting then the equity section. So I'm going to say this is going to be equal to the common stock. Going to go ahead and auto-fill that down, putting my cursor on it, grabbing the fill handle, dragging it on down. Then let's do some indentations from the shares to the common stock. We'll indent that, alignment and indent. Picking up the common stock, I'm going to indent that again, alignment and indent again. So we'll pick up the number of shares, these of course being the shares that are outstanding issued from the company to owners of the company, those being stockholders. The initial issuance from the company to the owners does not mean that the owner, the original owner, still has that stock. They could have sold it on the secondary market, but the common stock portion represents the investments by the owners, meaning the stockholders, into the company. Par value is at the $10. That's an arbitrary number that does not represent what we sold the stock for or what the market price is, but makes it a nice relationship between the number of shares and the common stock, unlike if we use the actual price, which would vary to whatever the market price is whenever we issue the stock. So I'm going to go to the underline, font group, and underline. We're going to multiply that out. That's going to be the 6,000 times the 10. When we issue the stock, we're going to get money over and above the par value, hopefully, and that difference is going to be the investment from the owner that we're going to format in the paid in capital or capital in excess of par. So in this case, the 60 and the 35 or the 95 represents money from the owners, kind of like an investment, as opposed to the retained earnings at the 55,000, which represents the earnings of the company flowing through the income statement from their activities to generate revenue, which has not yet been distributed back to the owners in the form of dividends, thereby or therefore being retained, hence the name retained earnings. So we're going to underline that, putting a line underneath it. We'll sum this up, equals the SUM of the 60, the 35, and the 55. That's going to give us the 150. Now we're going to change these as we go. Just to recap, what we imagine to happen is that the retained earnings is going to go down. It's going to go down because we're giving value just like a normal dividend, but this is a stock dividend. It's not a stock split, stock dividend. Therefore, retained earnings decreasing. It's going to go down by the market value, which is the $16 times the amount of new shares that will be issued for the 12% shares that are going out. Then we're going to have to adjust something else in the equity section to remain in balance, or in other words, for the total not to change, because there's no change in assets or liabilities, unlike with a cash dividend where there is a change to the cash, the asset. Here, only equity. Therefore, the other half is going to change the common stock in part due to the 6,000 shares increasing by the 12% increase, which will result in a $10 change, which will eat into or take care of 10 out of the $16 that we changed in retained earnings. The difference between the 16 and 10 and the new shares, the 12% new shares, will then be calculated here and adjusted in the capital in excess of par account. All right, so let's do it. Let's go ahead and do it. Enough talking. Enough talk. You're just a talker, man. It's time for action. We need action happening here. We don't like talkers. So we're going to take the shares. This is going to be the shares, and we're going to say that's going to be the 6,000. Remember, when you take the 6,000, you want to take it from over here, not in the blue area, because we're going to change that number. So when we change it, it'll mess everything up. And then we're going to take the stock dividends. Stock dividends are going to be the 12%. So that's going to be down here. This is going to be the 12% stock dividend. Let's go ahead and then say we want the home tab number group percent. We're going to underline that, font group and underline, and that's going to give us our new shares. So we got the new shares, then at equal to the 6,000 times the 12%. That's going to be 720 new shares. So now we can figure out what the common stock will be, this number, after we have the new shares that have been issued, because the par value will not change, unlike with a stock split where the par value would change. No change to the par value here, but the number of shares has gone up. Therefore, common stock total will increase as well. So what will that be? Well, we could say we have the beginning shares. In the beginning, there were shares. Those shares consisted of 6,000 shares. And then they multiplied due to a stock dividend with new shares of 720. Resulting in font group underline ending shares of equal to the sum SUM shift 9 6,000 plus 720 or 6,720. The par value has not changed. Par value is remaining the same at the $10 in our case. We'll pick up the $10 here, $10, and that's going to give us our common stock, which is going to be equal to the 6,720 times the 10 or 67,200. Let's put an underline under the 10, font group underline. So we expect then this number here to change to 6,720. This number then will change automatically due to our calculation at the $10 par to the 67,200. We're not going to do it yet, or I'm not going to do it yet. I'm going to do it later. If you can't wait and you need to do it now, do it now. But I'm going to do it later after we do the whole thing here for the equity section. So now we want to do the capital in excess of par calculation. What's going to happen with that one? Well, we have the beginning balance. Beginning balance. We have to start with the beginning. Not all the way back, but back as far as we know. In the beginning, back as far as we know, there was capital in excess of par. And it says part right there, but it should say par. Let's change that. Par. In the beginning, as far as we know, as far back as we can go, there was capital in excess of par at the 35,000. And then we had market price of the $16. Now, 10 of that 16 has been taken care of through the adjustment in the par value here that we did up top. Therefore, we're going to take the difference between the two, 16 minus the par value of $10 par value. And let's put an underline there by going to the font group and underline. That'll give us the difference. Let's make that a capital. Difference, which is going to be equal to 16 minus the 10. And that'll give us, and then we're going to multiply that times our new shares, which we calculated up top at the 720. We got 720 new shares. And that's going to be font group and underline, and that'll give us the change in the capital in excess of par. So the change that I'm going to put in the outer column, because we're going to have to add the change to what we had in the beginning, which is going to be the 6 times the 720. That's the change. So we got the 4,320 new amount in the capital in excess of par. Let's put an underline under that. We do that by putting a line underneath the number thus the name, underline. That'll give us our ending balance here, which I'm just going to call the capital in excess of par, which I'm just going to sum it up. I'm going to sum up the outer number equals the sum, even though there's a lot of blank cells, the 35,000 plus the 4320. So there we have the 39,320. We expect that then to be here, changing this amount. I'm not going to change it yet. I'm going to change it later. But if you can't wait, you can make the change as we go. I'm going to hold off here. The power of will is going to help me to hold off. William helps me with the power of will. So now we're going to do the retained earnings. So the retained earnings is the other side. Retained earnings represents the earnings that have not been distributed out. This is going to be for the full $16 times the 720, which is going to even us out here once we get done with this one. So what happens with it? Well, in the beginning, retained earnings, as far back as we can tell, had a beginning balance of the 55,000. And then there was a stock dividend, miraculously increasing the number of stocks by 720 increase. And if we then look at the market price determined by the market, which was 16, that resulted in a decrease in retained earnings from the distribution of the stocks at a value of 16 at the 720 times 16 decrease 11,520. Underlining the 6T font group and underlining, arriving at the ending retained earnings we now have of the 55,000 minus the 11,520, underlining the 11,520 font group and underline. So there 43,480 is what we'd expect to go here. Let's make the change now. If you were able to hold off with me, now we're going to do it. Now we get to do it, and this is where the weight pays off. So we're going to say that 6,000 is going to now change to this 6,720. And that multiplied times the par value at 10 gives us the 67.2 automatically. The capital in excess of par, we're going to change now to this 39,320. And then the retained earnings, as we just saw, it's going to be changed by this 43,480 down below. And there we have it. So notice the end result remains the same. Dividends went down by the full market price times the new shares, 720. The other half of that being split between common stock and paid in capital in excess of par. The common stock by the par value, which in this case happens to be 10% times the new shares. The capital in excess of par, therefore, is going to be the 16 minus the 10, or 6, times the new shares, the 720, resulting in the result of being the same for the total retained earnings. Okay, what happens then to the earnings per share, you might say? You might say, well, what happens to the earnings per share? That's what we'll look at now. Well, let's think about the beginning earnings per share. We're going to look at the earnings, kind of like the income statement, bottom line income statement number. Performance number here, 24,000 we're given, and we're going to compare that to the number of shares that we started at. So we started at the number of shares, which was 6,000. This is our earnings per share in the beginning. We're going to go to the font group and underline. This is going to give us our earnings per share. This is going to be equal to the 24,000 divided by the 6. I think that's even, but let's add some pennies anyways. Number group, add a couple pennies. Then what happens once we have the stock dividend? Well, now we have more shares. The earnings going to remain the same. There's going to be a decrease in the earnings per share. However, if you think about it from an individual investor standpoint, they should have more shares. So it kind of evens itself out. You see how the whole thing's kind of working itself out here. We're going to say the earnings are going to stay the same at the 24,000. The shares, though, have gone up now to the 6,720, underlining that by going to the font group and underline, giving us the new earnings per share, the ending earnings per share, the 24,000 divided by the 6,720, or adding a couple decimals, number group decimals, 3.57. So earnings per share has gone down as would be expected. But again, if you're an individual stockholder, you would have got a stock dividend as well. So what would happen to the price then? Let's think about the price. So notice when you're thinking about the price, we're going to be using the price earnings ratio. So you might think first, if given the price earnings ratio, what that formula is, and then back into the price. So, but we're going to do the algebra on the price here. So the price is going to be the price earnings ratio, which we were given over here at the 4 on the price earnings ratio. Another 4. So there we have that. And then we're going to say 1 plus the stock dividend. So I'm going to say this is going to, that's going to be compared to the earnings per share that we just calculated at the 3.57, adding some decimals, number group, couple decimals, and that's going to give us our price. And that's going to be equal to the 4 times the 3.57, adding a couple decimals, number group, couple decimals. So we're at the 14.29 now, font group, underline. So the starting price we saw was the 16. We're now at the 14.29. So if that's the case, then we could think about, well, what would happen for our individual investor, thinking about the investor shares, what's their value. So we could think about what's going to happen to their shares, the beginning shares. Beginning shares were at 100. We're assuming this is an individual investor now. What if they held on to 100 shares and they got a 12% stock dividend? That means their shares are going to go up by 12%, resulting in an ending value of 1 plus the stock dividend, or it goes up by 112%, in other words, which is going to be equal to 1 plus the stock dividend of 12. And let's make that a percent, number group percent, add, we don't need a decimal, let's underline it, and that's going to give us the new investor shares, or ending investor shares, which is now at 100 plus 12% plus the original 100, 112% times 112. So it went up by 12%, or 112 shares. So then we can think about, okay, well, where did the investment value stand at the beginning? Where were they at the beginning value-wise? Well, we had the market price. We have the number of shares, let's say, beginning shares of $100, and the price in the beginning, we had the market price over here was, what did we say, 16 at the market price. That's where it started at in the beginning. Let's underline that, font group and underline. That's going to give us the value, which is going to be equal to 100 times 16. So where is the value at the end of this now that they have now that one investor has 112? We would expect it to end up basically in the same spot, given the fact that the market should react to the dividend in the way that we would expect, or what we would expect to happen is the market would reflect the fact more dividends are out there, even though the value of the underlying value of the company has not changed. And so it should be reflected in the price. So if we think about that, we'd say, okay, well, the investor shares at the end, now at 112 shares instead of 100, the price now being adjusted. So we're going to say price is now at the 14.29. This is determined by the market, but that's what we would expect to happen given what we did on the company side, adding a couple decimals, font group and underline. And this is going to give us the value after, which would be equal to 112 times the 14.29, or once again, the 1,600. So before the stock dividend, the investor has 100 shares, which equals, you would think, 1,600. After, you would expect the market to reflect a situation where the investor would now have 112. That's not dependent on the market, but the price you would expect would reflect the change, and change possibly to 14.29, resulting in the value remaining the same at the 1,600.